Welcome to your CPA's Take on Real Estate. We're your hosts, Daniel Roccanti and Kyle Paxton here for another episode. In today's episode, we're going to talk about some of the biggest mistakes, reporting mistakes that scare off your real estate investors. Kyle, this is a pretty big deal, I think, with a lot of our
Yeah.
investors because we put so much focus on actually obtaining the investor up front. Like, hey, fund my deal. And we forget that it's just as important to make them happy throughout the entire deal. And so sometimes a lot of effort goes up front in the beginning, and then we just will have a tendency to kind of slack off a little bit once we actually get going in the deal. And this is just very important because, your reporting is really the only way the investor knows if you're a good operator or not. So a lot of times you're being judged based on your reporting. Even if you're a great operator, the investor doesn't know if your reporting is bad.
Yeah. There's two things at play here when you make it. If I'm a passive investor in a real estate deal, right? The two things I'm looking for, am I actually making money? That's the biggest one. But then secondly, is communication clear from the start to finish of the deal, right? I think those are the two easiest things, just to say, yes, this is a great operator. No, this is a terrible operator, right? And then even, I have plenty of examples where the return is really good, but there's communication breakdowns, maybe around state and local tax implications. There's communication breakdowns around the timing of K1s being received. And regardless the number of the return, that can totally break trust and blow, that investor coming back. I've seen so many examples of that. So, we focus a lot on what the returns are and that you're getting your money plus back and what that timeline is and all that kind of stuff. But Daniel and we talk about this a lot in these conversations where we're saying this just comes down to trust, and you build trust with communication, right? So I think let's start by just kind of breaking down the delayed financial reporting part of this and the kind of communications around that and pain points that can cause.
Yeah, when you have reporting mistakes, this creates
Yeah.
uncertainty, okay, of your investors. And so what are some of the steps that we can do, or what are some of the biggest mistakes that we see um, in the reporting? And the first one Kyle already mentioned, and that is delayed financial
Yeah.
reporting. All right. I said I was going to have my financials or my investor reporting to you by X date, and it's late. Okay. What does this do? This is your first
Yeah.
impression. All right. This is where you want to make sure that you deliver. If you're constantly over promising and under delivering to your investors, that's going to catch up with you at some point. Okay. So making sure that you actually do what you say and file on time gives off a good impression. Now that uncertainty we talked about, okay, I know I'm going to get my reporting on a timely manner. And so you really need to understand, okay, what are my processes, or when can I actually deliver this on time? It's better to actually say, hey, I'm going to deliver this to you later and do it consistently than say thinking you can do it earlier and always under delivering basically. Well, so let's say I'm a great operator. I'm going to get it to you by the 15th of the end of every quarter. Okay. But I'm consistently giving it to you on the 25th. I'm 10 days late all the time. All right. So I'm always promising the 15th, but I'm under delivering and giving to you on the 25th. It'd be much better for me to just say, hey, I'm going to give it to you on the 25th after every quarter. And then I do that. I'm giving you the report on the same day, but my expectations are different. All right. Your investors are going to judge you
Yeah.
different because when you are constant delays, it signals that I have weak processes. I have poor property management. I have inadequate staffing. I have lack of financial controls. And then if you're constantly getting delayed, your investors are going to assume maybe you're hiding bad news.
Yeah. I
Okay.
like where you're going with
What?
this. Yeah.
Yeah. And so it's really important in yours that, all right, I need to go out. I need to start initially on a high note, find a date that is something I can actually do, and then meet
Keep
it
it consistent.
every single.
Yeah. I like
This will
I'm
be
sorry to talk over you here, Daniel, but perception is reality in this, right? And so as the investor, if I'm sitting back and waiting for this delayed reporting for the third time, whatever, I'm going two places. I mean, we're getting kind of deep in if we're saying, okay, our processes are weak and everything else is like the core reason why. But as the investor, I'm saying, A, you have bad news you're procrastinating on, which Daniel just touched on, or secondly, you're just not prioritizing me. Like that reporting piece to me is not important to you. And that's not something I want to see as an investor because I want you as the operator actively engaged in making sure I'm up to date on how my money is being deployed and what the results are. And I'm not going to be excited to invest again if I feel that breakdown in trust.
You just don't want to have a pattern of being
Yeah.
unreliable, basically. Okay. And so it happens sometimes. Sometimes delayed reporting happens. I mean, most of the investors are pretty reasonable and they're okay with an occasional delayed reporting. But if that is the case, you need to
Yeah.
communicate that early. You need to communicate that is there a delay. Silence is the worst thing you can do. Okay. And then you need to make sure that you're giving a little bit of an explanation of, okay, we're delayed for X reasons, but we're going to get it to you by X date. And then you follow through. And if that happens once or twice occasionally, most investors are going
It happens.
understanding
Yeah.
pattern in silence is the worst thing that you can do in this scenario.
Yeah, I really like the idea of operators having a reporting calendar with internal deadlines several days before those investor reports are due, making sure you're on a good cadence and, checking the boxes early in the month, early at the end of the quarter, whatever, so that you can get the reports off on time. We've beaten to death the idea in these of like we have real time data these days, or we should. So in theory, we're not spending a whole lot of time catching up data. It's more just distilling it in a way that makes sense. So let's jump into that a little bit and distilling the data in a way that makes sense. Daniel, take us through a little bit kind of like what you might see in an investor report, maybe like key performance metrics. And then if those are inconsistent over time or if they, are just flat out missing, it could cause me some heartburn as an investor.
Absolutely. So now we talked about making sure that your reports are on time. There's still a lot of mistakes that can be made once the actual reporting is given. One that we see a lot is missing performance
Yeah.
metrics. Okay, it's very common to show the financial statements. I got my balance sheet, I got my income statement, but your performance metrics is really what helps your investors understand what actually happened. How do I interpret my balance sheet and my income statement that I received? It's very important that you are giving your investors as much information as possible of what's going on. So it's just more than just, hey, here's my profits for my income statement. They're going to want to know what's your occupancy rates. Okay. They're going to know what is your rate collections, what is your delinquencies, what is your rental rate growth, all right, what is your concessions, all right, what's your net operating income. Big one is capital expenditures. What are you doing in capital expenditures? What are your progress on capital expenditures? What's your debt service cover ratio? These are all performance metrics that is just going to tell your story more to your investors and create that certainty that we're trying to for instead of having them reading numbers and just trying to come to their own conclusions.
And budget versus actual is very important here, I think. Like just having that transparency on here's what we expected, here's the actual results, and then here's why we have a variance is huge. If you run any sort of business on any sort of nonprofit board, like this budget versus actual is king, right? And it's helpful to understand data. So just along with those key metrics, assigning budgets to the key metrics and or the financial statements themselves can really help further demonstrate that transparency around what we expect. And so, like using an example of saying, okay, occupancy is at 91%. Whoop-de-doo. What does that actually mean, right? Is that increased or decreased what was originally projected? Why did the performance change to drive that? And then what are we doing? What's management doing to address that if it's an issue, right? So those are the kind of extra steps that go a long way in building that trust and transparency. That's important in this process.
Love the statement you just made, Kyle, right here. Really got to understand that these performance metrics they're not going to be as useful if there's no
Yeah.
comparison here. Because if I see 91% occupancy, like Kyle was saying, it's like,
Whoop-de-doo.
is that good? Yeah, it's like, what is that bad? I mean, like, it could be either way. if the previous quarter my occupancy was 95% and now I'm 91%, that might look
Yeah.
bad. Okay. But what if my previous month, or quarter was like 87%? 91% looks good. I'm on the uptick. All right. And then you need to make sure as management that you're explaining why there's a difference. Why is there a difference from last quarter? Why is it different from what you budgeted or your expectation? That's really what your investors are wanting. They're not always expecting you to meet expectations, but they're wanting a reasonable explanation of why it changed. Why did we not meet it? What's we doing? And then most importantly, what is management doing next, especially if we don't meet it, so that we can meet it going forward?
All good points. I want to take this conversation into cash. Cash is king. Cash flow is important. We talked about that return is very important on our investor perceptions here. So let's talk about some like cash flow reporting issues, right? Um, there's a million types of ways you can define income in reporting, right? And different stakeholders need different things. Your tax income is different than your book income, accounting income. What the heck does that mean? What's our operating cash flow compared to those things? So, being able to distinguish between, okay, here's our income on your tax return, what you see on your K1. Here's how that translates into operating cash flow. You have a lot of those big ticket tax only, not cash type items like bonus depreciation that can impact things you're capitalizing to the balance sheet that don't show up in that profit and loss statement as taxable income, debt payments, reserves, and then ultimately, what investors want to see is investor distributions, right? And so making sure there's good expectations around when cash is going to be coming out to return capital plus to the investors. Is huge, and then being able to explain any discrepancies around that. So, a lot of times we see mistakes around. A lot of the conversations I have are just mistakes and lack of understanding between reconciling tax income to the cash availability, right? Real estate's an illiquid asset. Takes a lot of capital to get going, and it's tied up in this thing that sits for however long we're keeping it, right? And so, I think it's really important that we have a good understanding on how cash correlates with the bottom line net income or loss your investors are getting on their tax returns. A big portion of the real estate equation and in real estate investing is around the capital expenditures, right? If we are making significant capital expenditures, a lot of cash is going towards those. You're potentially drawing down debt to go towards the capital expenditures. That's not being reflected in our income whatsoever until we add that depreciation layer, which is nice and convoluted, not actually tied to the cash you pay, directly, right? So there's a lot there that is really important to kind of lay out. I think another thing I see is, omitting reserve activity from our projections and modeling and kind of the ongoing communications and what that looks like. And then, you know, uh, sometimes we see where distributions aren't as expected, and that might happen. We've talked a lot about in this current environment, real estate's somewhat squeezed right now. Cash is tight. Distributions aren't, I'm not seeing them flow like I have in years past. And so just being able to kind of level set with your investors, get out in front, understanding why they're reduced or suspended, goes a long way here.
Yeah, let me add a little bit of
Yeah.
perspective to this. So when we're talking about cash flow, what are the mistakes that are being made here? Okay, because what is your investors expecting, right? First mistake I see is I don't even see a cash flow statement. So, right, really, it's very common not to
Yeah.
see a cash flow statement on it, an investor reporting. And like, why is that a big deal? Because Kyle mentioned is cash is king. All right. Your investors, they know cash.
Yeah.
Okay. They might not know what accrual basis accounting
I can
is.
assure you
They
they
might not
probably
be,
don't. Just
yeah, but they love cash and they're trying to understand, okay, why is it that, what cash is doing in it, my distributions, okay, and performance, why are they not lining up? You know, if I see that the company's not making any money on the income statement and I'm getting no distributions, okay, that's starting to line up. But what happens when I get an income statement that shows that the the investment is very profitable? And then I'm getting told by management that, hey, we're reducing your distributions because there's not enough cash. And you're like, well, that doesn't make any sense now. Right? So the cash flow statement really explains that because full basis accounting is completely different than cash. I mean, we could have large capital improvements we have to do. Okay. You can't write off all those large capital improvements. You have to depreciate them over time, right? Little things like that can be a huge difference of why an income statement can show profit, but distributions are small because there's no cash in the company. Your cash flow statement is your chance to explain that to your investor, and you're just completing the picture. Okay. Without all this information, you're just giving the investor a chance to basically mind go wild and come up to its own conclusions because you have uncertainty in your reporting. And that's what don't want to do with your investors. You want certainty. You want to be okay. Hey, I said we're reducing our distributions. The cash flow statement is showing why we're doing that. So it's really important that, you are making sure that your investors truly understand why the cash is different than your actual income statement.
All good points, Daniel. And this is an area where I really like having conversations around the cash flow, how cash is flowing, what people are seeing in this. So I'd love if you could leave a comment to our viewers on if you're having, having some uh, cash flow troubles right now, what that looks like, any pain points you've experienced with that, or on the flip side, I'd love, if we're able to share some like success stories around communications with distributions and maybe working with challenging investors, things like that, would be super helpful for our crew here. To kind of take us to the end here, let's go through and talk about. We've hashed this out some in these videos, but I think it's important to kind of regroup here. With our we work with a lot of real estate syndication funds, right? And those can oftentimes have multiple properties within one umbrella, or they're getting K1s from different sources that are flowing through a fund setup. Daniel, can you take us through a little bit, just kind of, let's do a reminder on kind of property level reporting and then fund level reporting, and maybe where those can cause confusion and the disconnect between the two?
Yeah. Well, another mistake we see is fund level versus property level. Okay. And the biggest difference here is property level is the actual property. All right. The fund's the bigger deal of a fund. Sometimes you might just have one property and that is your fund.
Yeah.
Right. And not as much separation. But when you start dealing with bigger deals, there could be multiple properties. Okay. And so the fund level reporting and the property level reporting, you need to have both, and they both tell a different story. Okay. Your fund level is really telling you what your overall portfolio performance is. All right. It's giving you more high level, like what is the total expenses? What is my management fees? All right. What is cash fee? Capital calls, distributions, debt obligations. All right. Just kind of like the overall investor return. That property level is really getting to explaining, all right, what is my actual operating performance for this property? Okay. I want to know property specific, what its capital projects are, what its operations are, what its challenges are, what's the plan for this one. Okay. Because the fund level one, if you just, basically throw everything together and do a more aggregated approach, you can actually kind of hurt your investors' insight into, hey, this property is not doing well. This property is doing really well. And so when you put them together, it looks like everything's doing good. Okay. And you're not actually showing what properties are underperforming and what properties are overperforming. All right. So it's important that you're basically showing both ways, because that aggregation can kind of be a great way to accidentally hide both strong and weak here performances. And so your investor might need to know everything, good and bad, that's happening at your properties.
Yeah, Daniel, I have some recent pain around this with some groups that I work with, and I've seen kind of examples of where the fund, to your point, exactly muddies the property, right? So let's say I put $1 million into a fund, and the fund manager tells me, "Hey, your $1 million, 1/3's going into this property, 1/3's going into this property, 1/3's going into this property." Hypothetically speaking, let's say one of those properties in a disaster scenario is foreclosed upon, right? And I'm not going to get any money back of my 1/3 I put in there. Well, how then the impact of that foreclosure, potentially there could be items of gain that come out of that. I'm talking about from the tax side here, items of gain that come out of that because I took significant depreciation against debt. So in my head, I'm saying, like, I think my first reaction would say, hey, I put in 333,000 into this property. I'm getting zero back. I should have a $333,000 loss, right? But then there's two tiers of operating agreements in this structure where you have the potentially property level, if that's a separate entity, and then a fund level operating agreement dictating how taxable income and loss is allocated. That can differ from cash in a partnership structure. And so I've seen a lot of surprises come out of where fund level reporting, at the end, when this fund winds down, it's all going to tie back to the actual cash that you got out. But there can be timing differences there, just depending on how the operating agreements dictate that income is allocated, things like that. So both of these are super important. It's very important to outline the individual property, performance. It's important to actually outline the fund performance and then get out in front of, um, like helping, I guess, translate the mechanics of the tax impacts of the fund structure to your investors. And that can cause a lot of headaches and pain and trust issues.
Yeah, and the goal here is you need to provide clarity to your investors. Okay, so we're going to get into our last mistake here that will really help in providing clarity, and that is through transparency. All right, transparency creates confidence. All right, transparency does not mean that we're only reporting negative information. Transparency means that the results need to be presented balanced, consistent, and in an understandable way. Okay, you got to give the good, you got to give the bad, but it needs to be the same in every reporting. All right. You don't want to be using different metrics, skewing the results. Okay. Everything needs to be the same. And whether it's positive or negative developments, it needs to be reported. Okay. You need to be identifying emerging risks before they become problems, making sure that you are telling your investors. You need to explain and describe your corrective actions if there are problems. All right. If there's any kind of prior period commitments like capital improvements, you need to provide updates. All right. And then everything needs to be consistent. Definitions, your reporting format. You don't want to be changing. If I'm getting a different format for reporting every time, that's going to be a problem. All right. And then I clearly need to make sure that I am giving the facts and then I'm being clear on if it's a fact or is it an estimate. Okay. Or if it's a management expectations. All right. We don't want our investors think that you're giving what you think is going to happen based on estimate, and they're taking that as fact here. All right. Credibility is the big difference. You can build your credibility as an operator by acknowledging your problems earlier. You're going to win your investors over. And so this is going to go a long ways to making sure your investors are happy, not only for this deal, but so that they can start investing into future deals, which is where you really want for all your current investors is a win now and then future wins as we have take more deals on for our investors.
Clarity is important here, Daniel. The absolute worst is results were impacted by market conditions. That's a big old boo for me. You really got to get more granular than that and help your investors understand. I really like talking through just kind of a communication framework here, right? We use this internally at James Moore when we send out communications to our staff, right? Because you potentially in your investor group, you have a million different communication styles. If you're familiar with DISC or a similar type of personality test, you got all types of types in your investor pool, right? And they're going to want information in different ways. And so having a consistent framework of communication helps with expectations. It can be as simple as what happened? Why did it happen? What's management doing? And what should investors expect next? Bam, 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 bam. And then you cover a little bit of everything, right? What's the problem? How are we approaching it? And where do we go from here? How does it impact you? Love that kind of stuff. And having that consistency and expectation around what those communications look like really help alleviate a lot of stress. All right, Daniel, take it up. Sorry. I was going to say, take us out of here, but you got more to add, my friend.
I was just going to say, answering those 4 questions right there will really building a credibility to your investors. It doesn't seem like once you break it down, it doesn't
come on.
My investors just want to know what happened, when did it happen, what is management doing, and what should investors expect next. And so that is really what it comes down to. That's all transparency is. Okay. And so that basically brings us here to our end, and so we just want to make sure that we kind of do a slight recap here. All right. So most damaging reporting mistakes that we are seeing. All right. Delivering your reports late. You're omitting performance metrics. All right. Failing to even provide a cash flow or explaining your cash flow. All right. Blurring the lines between fund level and property level results, and then not being transparent and avoiding difficult information. Okay. If you can do these things effectively, all right, those things will basically help you with your investors by basically just being timely, consistent, providing comparables, and just being honest about your performance in it. So we're glad you were able to stop by today. We encourage that you will leave some comments in here, anything that you want to talk about. If anything we talked about, you have additional questions on that. We're always looking for other topic ideas.
Yeah.
Kyle and I come up with topic ideas, but we're always looking at what is our listeners, what do our readers want to actually hear? Is there any topics out there right now that's important to you? And please put those down in the comments, and we'll definitely look at it and try our best to reach these comments. So we're here to give our listeners what they want. So thanks for stopping by, and see you next time.